Let's take a look at the full chart going all the way to today. You can see that after this huge rally that we had from 1994 all the way through the year 2000, the market really kind of backed off a bit, dropped 50%, and we rallied again up to a new high. And you can see that right after this period of volatility in which there were wide-ranging bars, let's just zoom in on this, you could see that the selling pressure was being absorbed by buying here and here and here, and it did so with high volume when the market was making new highs. And then the bars started getting smaller and smaller and smaller, and it was that time when you probably could have made a determination that in fact there was going to be another significant rally based on the fact that the volume, both the volume and the size of the bars and the range of the bars was getting smaller and smaller, and in fact a very significant rally did take place from this period all the way through again until 2007, 2008. And at that time, of course, volatility started to come back into the market again, and the market sold off. So there's a lot that can be gleaned from a chart as far as both volatility and a volume perspective. And it's important to understand what these conditions are in which you want to trade. Go through this because a major problem in trading involves the correct timing of trades. And the solution, of course, lies in being more accurate in initiating positions. So if you can do this type of analysis, your percentage of correctly timed trades is going to be greater. What you need to do is seek to establish positions which are in the direction of both the major and the minor trends. So for example, and you also want to take a look, of course, at the position of potential change in the market. But you want to take advantage of those major and minor trends. In the case when we come back down to this particular time period in the chart, the major trend was still up. The minor trend may have been down, but even the minor trend on a weekly basis, you could tell was still, somewhat up. It was the market looked like it was continuing to go higher. Previous to 1993, there was about a 3-year period of a rally, and this was simply a consolidation pattern leading to a new high. The major trend almost always persists longer than you ever think it will. For example, a lot of people I'm sure that got into the position here may have thought when the SPY reached, say, 50, when there was this little consolidation period here, that was probably the end of the trade and they decided to get out. Well, they missed a huge advance going forward. So the trends, once a market starts trending, it generally persists much longer than you ever think possible. Let's take a look at the current state of the market. What single event here in this, from what you can see from this chart, would give you some pause based on the analysis that we've undertaken over the last couple of videos? Well, if you take a look at this chart, you can see that the market was falling into March of 2009, and then it rallied strongly. One of the clues that the rally was over, of course, is the lessening of volume as the market hit a new low. Right here, we had a significant high volume, a couple high volume weeks, and the markets continued to sell off. However, it did so on much lighter volume. The market started to rally strongly on lighter volume, but looks like most of the selling had been absorbed and there were no sellers coming into the market for several weeks. At that point, you could have made a determination that the market was in a new uptrend. If we take a look at, in fact, at the point where this pullback took place, you could see that these the selling that took place after the market had first initially rallied, the bars that showed up on the weekly charts were relatively small in range, and in addition, the volume was extremely light. That would have given you probably the major clue that this pullback was not leading to an additional decline that would break this previous low, but this pullback was a buying opportunity. The small range of these bars, along with lighter volume on the selling, indicated that sellers were starting to dry up, and there weren't any more sellers coming into the market to sell this market lower. At that point, you could have initiated a long position, and certainly would have profited handsomely from the advance that took place. In addition, these bars started to get smaller and smaller. The ranges were smaller, indicating that volatility was probably going to start declining. We didn't hit any volatility until we got into this period right here, with a minor bout of volatility here, indicating that future volatility was coming. Remember, in the last video we said that usually there's a preceding event to a high volatility environment, and this would have given you a clue with rising volume that, in fact, over these 4 weeks period, some additional volatility was going to come into the market, but it wasn't ready to come in yet.